Several of you have been asking in the comments about silver's recent move and what it actually means. Not the dramatic version, not the end of the dollar version, the honest version. Today we are going to separate signal from noise, and you are going to walk away clearer on what matters, what does not, and what this move may really be telling us. This is Go Finance. There are two different claims being mixed together right now, and it is important to separate them. The first claim is that silver strength is real. That part is not hard to defend. Silver has moved hard enough to get serious attention. Gold has been trading at levels that would have sounded almost unbelievable not long ago. Gold futures sitting around the mid $4,000 range, silver futures near $70. The whole metal space is no longer some sleepy corner nobody watches. The second claim is much bigger. That a strong move in silver automatically means a full dollar system endgame is right around the corner. That is where we need to slow down. Not because the system is healthy, not because debt does not matter, not because paper claims are somehow safe, but because one explosive move, even a real one, does not prove the timetable people want to attach to it. If you get the timing wrong, you can still be directionally right and financially miserable. You can panic too early. You can position too aggressively. You can talk yourself into believing every strange price move is final proof that the curtain is about to fall. Meanwhile, the machine keeps running longer than you expected. Here's the actual backdrop right now. Official inflation is running around 2.5% from a year earlier. The Federal Reserve held short-term rates in the mid-3% range at its March meeting. Broad money sits just under $23 trillion. The national debt is brushing up against $39 trillion. And the 10-year Treasury yield has been hanging around 4.5%. That is not a normal, relaxed backdrop. That is a system still functioning, but under pressure from multiple directions simultaneously. Inflation is lower than the panic crowd wants to shout about, but not low enough for the central bank to declare victory. Rates are not crushingly high by old historical standards, but high enough to make a debt-heavy system uncomfortable. Money growth never really stopped being a long-term issue, and Washington is carrying a debt load so large that every move in yields matters more than it used to. That is the real tension. Not one price candle, not one war headline, not one loud prediction. The system now needs a very delicate balance. Growth, but not too much inflation. Lower inflation, but not a credit seizure. Stable bonds, but endless borrowing. Confidence, while everybody can see the math getting uglier. That is a hard balance to keep. When people see silver rip higher, they usually do one of two things. Either they get euphoric and think the reset is here, or they get cynical and say metals are just another momentum trade, and none of the monetary arguments matter. Both reactions are too simple. Silver is part monetary metal, part industrial metal, part panic barometer, part speculation magnet. When it moves, it can be sending several messages at once. Some about inflation expectations, some about supply tightness, some about industrial demand, some about distrust in financial assets, and some are just traders chasing what is working. All of that can be true at the same time. Here is something most people get wrong about how safe havens actually work. Safe haven does not mean straight line up every minute fear rises. That is not how real liquidation works. In the early phase of stress, people do not sell what they hate first. They sell what they can sell first. That is a huge difference. If leverage is involved, if margin calls are hitting, if redemptions are forcing action, if businesses need cash today and not next month, then liquid assets become the first source of relief. Sometimes the strongest, cleanest asset gets sold precisely because it still has a bid. That is not a failure of the asset. That is a symptom of a funding scramble. Think of it this way. If somebody's house catches fire, they do not begin by organizing the closet. They grab whatever is near the door. That does not mean the thing they left behind was worthless. It means chaos changes the order of decision-making. Markets do that too. They do not move by textbook purity. They move by who needs cash, how fast, and what can be dumped without completely breaking the screen. So, when someone asks why gold and silver did not instantly behave like movie version safe havens, the second tensions rose. The answer is straightforward. In a debt-driven market, funding stress hits first. Narratives catch up later. And here is one of the biggest misunderstandings in the whole metals conversation. A lot of people talk as if there is one market for gold and silver. There is not. There are layers. Physical metal in hand, metal in storage, futures contracts, exchange-traded products, mining shares, options, promises connected to promises connected to promises. Those layers do not always move with the same urgency. They especially do not move with the same honesty. That is why a person can look at a screen quote and say nothing is happening, while a dealer, fabricator, or desperate buyer is saying something is definitely happening, just not where you're looking. Price is often discovered in the most leveraged part of the structure first, not the most stable part. That means a paper-heavy arena can set the mood, even when the physical side is tighter than most people realize. That can suppress a message for a while, but for a while, not forever. Now let us talk about the dollar side of this, because this is where the real heart of the concern sits. The modern system runs on debt, refinancing, rollover, and confidence. You do not need to call it anything extreme to recognize the vulnerability. You just need to understand that a structure this indebted depends on motion. It depends on loans being serviceable. It depends on refinancing staying possible. It depends on yields not rising too far too fast. It depends on people still wanting the paper. Once that rhythm breaks, you start getting stress in places that looked fine only a month earlier. This is why rising yields matter so much. Not because a high handle on the long bond is automatically civilization ending, but because when the debt pile gets massive enough, a move that once looked manageable starts acting like a pressure multiplier. Every refinancing becomes more painful. Every budget assumption gets weaker. Every risk asset has to compete with a higher baseline yield. And every rescue gets more politically difficult. Watch the bond market. Watch funding conditions. Watch whether the central bank is being pulled toward easier policy because the economy is weakening or kept from easing because inflation and commodity pressure will not let it breathe. If those forces start colliding harder, that is when the metals story gets more interesting. Now, let me address something that gets said for dramatic effect but rarely explained properly. The system can be distorted and still continue functioning longer than expected. A market can be stretched and still settle enough claims to keep things going. A pricing system can lose credibility at the edges before it fully breaks in the center. Those stages matter. If you skip them, you end up treating every sign of strain like final collapse. That is not serious analysis. That is emotional relief disguised as analysis. Here is the more realistic picture. The system can remain functional and fragile at the same time. The dollar can stay dominant and still lose purchasing power over time. Rates can stay elevated and still fail to restore real confidence. Metals can look strong and still scare people with volatility. And a crisis can begin as a liquidity problem before it reveals itself as a confidence problem. That sequence is critical. A liquidity crisis makes people chase cash. A confidence crisis makes people question the cash itself. Those are not the same thing, and they do not happen at the same speed. The early phase rewards liquidity. The later phase rewards credibility. That is why gold and silver can look disappointing right before they start looking essential. And this brings us to retirement. If a retirement structure depends almost entirely on financial assets staying richly valued, on rates behaving, on inflation behaving, and on the public keeping faith in long-dated promises, then that structure is more fragile than the glossy brochure makes it look. That does not mean every retirement account is doomed tomorrow. It means concentration risk is real. It means counterparty chains matter. It means inflation-adjusted outcomes matter more than nominal headlines. And it means real diversification is not just owning more paper wrappers around the same broad system. Sometimes, real diversification means owning something outside the chain, something you do not need a permission screen to believe exists. That is where metals re-enter the conversation seriously, not as magic beans, not as a religion, but as one of the few assets ordinary people can still understand without needing an institutional decoder ring. Weight, real. No earnings call, no guidance revision, no management spin, no promise to pay later if conditions allow. That simplicity is powerful in a very complicated age. And here is something worth noting. Fort Knox still holds roughly 147 million ounces, about half of the Treasury's stored gold. In other words, even in a fully modern financial era, the state still keeps a giant pile of hard metal tucked away. At the highest level, nobody really believes pure abstraction is enough. They may operate on abstraction every day. But when it comes to ultimate reserve confidence, hard assets still matter. Now let us deal with hyperinflation directly because it is the biggest fear being discussed. Could it happen? In theory, yes. Can confidence in a currency fail much faster than experts expect? Absolutely. Do governments under stress choose inflationary paths because they are politically easier than honest austerity? Very often. But not every debt-heavy country with inflation problems becomes an overnight hyperinflation case. Not every central bank rescue leads directly to currency death on a short schedule. Sometimes you get rolling inflation. Sometimes you get policy lurches. Sometimes you get asset booms and public squeeze at the same time. Sometimes you get repeated rescues that extend the life of the system while making its quality worse. That slower decay is not comforting, but it is more realistic than treating every rescue as the final hour. Here is what to actually watch. Watch whether bond buyers demand more compensation. Watch whether the central bank looks trapped between inflation and growth weakness. Watch whether commodities stay firm while real household finances weaken. Watch whether public trust in future purchasing power keeps fading. Watch whether the distance between official calm and lived experience keeps widening. That gap is everything. Because once the public no longer believes the official story matches real life, the emotional foundation of the currency starts weakening. And when that happens, hard assets usually do not need everybody's approval. They just need enough people quietly seeking credibility. Here's the part that gets ignored because doom gets more clicks. If the current system becomes less trustworthy over time, then people with real savings, useful skills, and lower dependence on leverage gain relative strength. Not overnight, not in some fantasy scenario, but in practical terms. Every economy, no matter how distorted, still needs builders, still needs repair, still needs food processing, still needs transport, still needs local service businesses, still needs people who can take depreciating chaos and turn it into functioning production. A reset, if it comes in any form, is not just destruction. It is also repricing, and repricing creates openings. Painful openings, yes. Messy openings, absolutely. But openings. Real savings will matter in that environment. Real judgment will matter. Patience will matter. And the people who kept even a little optionality outside the main paper chain will likely feel a lot less trapped. So here's the clean takeaway. Silver's move matters. It matters because it signals a tension, pressure, and a growing discomfort with the old assumptions. It matters because the debt backdrop is heavy, the rate backdrop is tricky, and the confidence backdrop is not what it was. But the bigger issue ahead is not one perfect apocalypse scene. It is the continued collision between too much debt, too much dependence on confidence, and too little room for policy error. That collision can produce fear waves, liquidity scrambles, forced selling, strange metal behavior, and then later a more serious move toward real assets once the cash scramble gives way to a trust scramble. That is the sequence to keep in mind. We are stackers here. We understand that preparation matters more than prediction. You do not need perfect timing to improve your position. You just need to stop waiting for universal confirmation, because universal confirmation is usually the last thing to arrive. The real signal in silver is not that you should lose your mind. It is that you should stop trusting easy narratives, start respecting financial fragility, and build a position that lets you think clearly no matter what comes next. Drop a comment below. Where are you watching from? Do you think silver's move is a real warning shot for a bigger monetary problem, or is the market getting ahead of itself? I read every comment, and I will pin the best analysis. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines, just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe, turn on notifications, data before price. Go Finance.